Good morning, participants, and most welcome to this webinar on Finance Bill. I'm going to request that we delay for the next 4 minutes to 5 so that we can allow more participants to join. Subsequently, we'll have also the panelists to join the webinar so that we can start all of us. So my sincere apologies, but we're going to start a little bit late by about 7 minutes. Good morning, ladies and gentlemen, our esteemed members, the board members here present, the chairs of various board committee, our chief executive, Mr. Anthony Mwangi, members of staff, members of Fourth Estates, karibuni sana. You're most welcome to this webinar that we've organized so that we can interact with Finance Bill 2023. And understand its positive and possible negative implications is likely to have on the manufacturing sector and the economy in general. We know very well since it came to light about 10 days ago, there has been a lot of discussions that have been happening at the national level. And in one way or the other, we have been involved in these discussions to try and understand the mechanics within the government, the ideologies and the philosophies within the government around the Finance Bill 2023, so that when we are offering a response, we can offer a better response that is responsive to the common good. So we are going to undertake this webinar for the next 2 hours, and we have a program that has been put in place. And during that period, I would request that we mute all our videos and our mics if you're not speaking. I would also encourage those who are on the road and probably they're listening to this webinar or they're driving to ensure that they're observing the road safety. If at all, it can call for you to park by the roadside a bit, listen to the webinar, and then continue with the journey. It's all for our safety. To those who are seated in offices, ensure that your ergonomic standing is okay, so that you don't strain your body at all in the next 2 hours. So we have a program, as I have noted, which we are running with. We're going to start with welcoming remarks coming from Anthony Mwangi, CEO. Then we have remarks made by the board chair, the board of the director, and also the chair of TTC. Also, Hadija Nanyomo will make some opening remarks. After that, we'll have a presentation being made by Ms. Rachel Jugona and also Mr. Stephen Degwa, both from EY. And then we have a panel discussion whereby we will be responding to the questions that are coming from the floor of this webinar. So again, I can encourage you that you type your questions where we have the Q&A or the chat section. And then with some of them are going to be responded live, and others are going to be typed back to you. And then after that, we're going to have the vote of thanks passed by myself. So I'm going to be the moderator, and my name is Joe Bonjohi. I'm the head of policy research and advocacy here at Kenya Association of Manufacturers, and I sincerely welcome all of you. So as we unpack, we expect various questions to come through from Tax Procedure Act, from the excess duty, VAT, talk of income tax, and various other taxation policies that we have around. So at this point, I want to welcome my CEO, Mr. Anthony Mwangi, to make some welcoming remarks.
So, Job, thank you. And I don't know, I think the video is disabled, so I'm unable to put on my video. I think it's a setup by the organizers. Can you hear me?
Yes, can I hear you, Anthony?
Okay, so there is a video, the feature is disabled. So if you can be able to enable that, I'll appreciate that. But in the meantime, I'll be happy to continue my remarks. And I want to welcome everyone on board. I can see we have in excess of 105 on board this webinar. And I want to first appreciate the time you've taken to join. I think this is one of the most consequential legislation, which is omnibus in nature. It affects many other legislation. from income tax to excise to Employment Act to import-export, so quite extensive in nature. And as Job has said, and Job, you've recognized, all the people that we have on the call, our board members, our members of CAM, our support organizations, the tax experts. So that protocol has been done. All protocols observed. As Job has said, my name is Anthony, and I just make a few remarks. As you're aware, that manufacturing is such an important sector in the economy of Kenya. Outside agri and public sector, we have the highest number of employees. We're largest employer, so quite significant. Our contribution to GDP in excess of 1 trillion shillings. Our contribution to tax coffers, 18%, which translates to about 360 billion. And this in nature and all the linkages that we have with other sectors, it's really broad, and there's no country that can develop without a strong manufacturing base. Obviously, we are coming from what we've called trimester, a trilemma, drought that has been ravaging the country, part of last year and early this year. We have the war in Ukraine and Russia that has disrupted supply chains. We have COVID, of course, not fully recovered, inflation, forex situation. So our hope was that we'll see a bill or Finance Bill 2023 very pro-production, geared towards restarting the giving incentive to the economy, giving it a jack up so that we can be able to produce more. But the way we have looked at it, it could be a mixed bag. And that is why we really want all the hands on deck to be able to present a compelling story, a compelling submission to the National Assembly. And this process started way last year. We presented the domestic budget proposals to the National Treasury. And then, some of the things have been taken on board, a few, but also there are things that we think they are of concern. So the reason we are here today is highlight and underscore the importance of what we're doing, the steps that we have taken, and to just bring everybody up to speed with the proposals that are there. We recognize not all member companies have the legal, departments or finance experts within their organizations, and that's why we play that role. And I hope by the end of this webinar, we'll be able, all of us, to be able to contribute, to or understand exactly what the proposals are. Because this is really, really important in terms of your planning for your businesses in the next cycle, your budget cycle. As I conclude, we reiterate the Secretariat and the board, commitment to work with government. It's become a bit tumultuous, because of the new administration. But there are areas of alignment that we have established, and we'll continue playing a leading role, that leadership role to see where we're getting. So we've done a lot of deep dives on different sectors together with the government. We can see they have onboarded some of the pillars that we've been given by the board. Export-led growth now is part of the cabinet approved strategy. So we have seen that there are quite a number of areas that we're cooperating with them. Of course, that doesn't mean there are no challenges. The challenges are there. They've always been there. They've always been there. It's just looking at how do we move together in tandem with government. So with those few remarks, I give it back to Job, and I look forward to a very fruitful deliberation. We spent a whole day yesterday just looking at, again, deep diving on the bill. And we will assure you that our submissions will go in as per the deadline set up by the National Assembly, and then we'll follow up with meetings with them and present oral presentation. to the National Assembly. Thank you very much, John, and thank you, everyone.
Thank you so much, Anthony, for making those welcoming remarks and noting the much work that CAM is doing currently to ensure that we align with the government, at the same time challenging the government so that we can increase on the GDP contribution. At this point, I want to recognize two board members, that is Mushai Konyiha and also Mihail Shalishaza, who is also a CAM director, and he will also be participating in the panel discussion. Again, at this point, I want to invite Hadija Nanyomo, who is a partner and principal dealing with indirect tax at Annex & Young LLP, to also make some opening remarks.
Thank you, Job, and warm welcome to everyone this morning. It's great indeed that we are all sitting here to unpack the Finance Bill 2023. This bill is quite special. One, I think it's almost 70 pages. Two, it's a bill that has been proposed by a new dispensation. And three, it has quite a couple of changes that are either controversial or good for all of us. It's not all bad. We at Ernst & Young, I bring greetings to everyone here, and we are happy to be partnering with the Kenya Association of Manufacturing. We at Ernst & Young appreciate and acknowledge the importance of manufacturing and the sector at large in the economy of Kenya. And we believe that it's a sector that can re-engineer and enhance the growth of Kenya as a nation, as well as the whole of the East Africa. This finance bill this year has had quite a bit of issues coming up. There's a lot that we all here need to understand. And what I would urge everyone here is to fully participate. Make your voice be heard. It doesn't matter what the outcome will be, but we need to listen in and see how this impacts us as individuals, as companies, and as government as a whole. So I'm urging everyone to listen in attentively and also to make sure that by 22nd May, when we are submitting the proposals or when we are meeting Parliament for public participation, everyone's voice has been fully heard and all progresses well. I wish everyone a happy listening and a happy contribution to the session. Thank you.
Thank you, Hadija, and I want to appreciate the partnership that we have been having with EY, with close coordination with Hadija in unpacking the various finance bills for the last couple of years. You have become quite instrumental in ensuring that we really understand what is the implication of the tax proposals that are put in the finance bill. So at this point now, without wasting time, we're going to move into the presentation that is going to be made by Rachel Jugona and Stephen Ndegwa, both from EY and the senior managers, one dealing with the business tax services, that's Rachel Jugona, and Stephen Ndegwa dealing with indirect taxes. So they're going to take us through the implications of the proposed tax policy measures in the Finance Bill 2023 on the manufacturing sector. I believe when you'll be listening to the presentation, it's going to cause a sweet tooth. At the same time, it's going to cause some fire in the belly. And it's this fire that is in the belly that is going to lead you in writing a few questions for us at the Q&A session, and at the Q&A platform, and also the chat platform. So we'd like to see these questions coming up more and more when you listen to some of these proposals that are coming up. Some are having good and positive impact on the manufacturing sector, but others are likely to have a serious ramification. So time for you, Rachel and Stephen, so that you can take us through this. Over to you.
Thank you, Job, and good morning, everyone. Hope, Job, I can be heard.
You can be heard, Rachel.
My screen can be seen.
Very, very well.
All right. So I will take you through the direct tax proposals, and my colleague Stephen will take you through the indirect. And after that, I'll take you through the other proposals touching on tax administration. So the first proposal is about social media influencers and content creators. What you've seen in the recent 2 years, several proposals have been put or tax measures have been put into our tax law to try and tax the digital economy. And this year is not an exception. So the proposal here is to tax social media influencers and content creators through a withholding tax system. So for the manufacturers here, the key point to note is that if you're paying a social media influencer, maybe to advertise your goods, if the bill is enacted, okay?
Rachel, I would encourage that you put the presentation in the presentation mode so that it beams better. Thank you.
Are we okay?
Go ahead. Yeah, we are good now.
All right. So what I was saying is that for the manufacturers in the room, if the bill is enacted in its current form, it will mean that before payment of any advertisement services to the social media influencers, then you'll be required to pay to withhold tax at 15% on the payments made to these people. And the effective date of this proposal is 1st of July, 2023. The next one is a new thing, and well, not very new because the income tax bill 2018 had proposed this change that for branches, there will be an additional tax called branch repatriation tax over and above the corporate tax payable by branch setups. So the bill has proposed a mechanism of computing this tax, and this is essentially the difference in the net assets at the beginning of the year and at the end of the year. However, the bill left out the tax rate for this. So we expect if this proposal sees its way into the Finance Act, then there will be a rate that will be proposed on this one. And the second item is that the bill also proposes to reduce the corporate tax rate for branches from 37.5% to 30%, akin to incorporated entities. So if this proposal sees the light of day, will not be the first, because Uganda and Ethiopia has this branch repatriation tax in their income tax legislations. So maybe the question here for people to ask themselves is whether there will be any advantage in having a branch set up vis-a-vis a subsidiary because of the additional taxes to be payable by branches. And this is supposed to be effective from 1st of January next year. The other proposal is about the introduction of indirect capital gains. And what we have in the current law is indirect capital gains on transfers in the extractive sector. That is for the mining and petroleum operations. So what the bill proposes is to extend these to other sectors of the economy, and it will be taxed as a capital gains tax under the current tax regime, and the current rate is 15%. And this will be taxable if whatever property or whatever interest you're transferring derives 20% or more of their value from property situated in Kenya. This will have far and wide-reaching implications, because as I said, currently it's only restricted to the extractive sector, and this has an effective date of 1st of July, 2023. Moving on, we know like 2 years ago, the government came up with exemptions from capital gains tax in regard to group reorganizations. And the exemptions are such that if the property is being transferred within the group with no involvement of a third party, then that transaction is exempt from capital gains tax. So the proposal in the current bill is such that it is an anti-abuse provision. Number one, it proposes to claw back any exemptions if you transfer the property within a period of less than 5 years after taking advantage of the exemptions. And number two, it also says that you cannot take advantage of the exemption if the group has existed for a period of less than 24 months. So these provisions are in the form of anti-abuse and just trying to protect the tax base. And this will be effective from 1st of July if the bill is enacted in its current form. Then in our country, I know we've talked about the teams and the e-teams from a VAT compliance perspective. And now this is being extended to cover corporate tax to the effect that for corporate tax purposes, a taxpayer will not be allowed to deduct any expense or cost where the invoice has not been generated through the electronic tax register. Anyway, this doesn't seem very far from what you've seen from a VAT perspective. Now the question is, what about businesses that generate invoices and they are not registered for VAT? What happens? For instance, if you get a bank charge from your bank, how would you be able to support that? However, the law has provided that there will be some exemptions under the Tax Procedures Act through a Gazette notice. We await to see how that will span out, and the effective date of that is supposed to be 1st of January next year. Then the other one is more of a compliance issue because there's a proposal to impose withholding tax on local sales promotion and marketing services. Remember in 2020, these services were brought under the ambit of withholding tax from a non-resident perspective. So the proposal here is to extend this to the local service providers, and the withholding tax rate would be at 5%. So this is just a compliance issue, making sure that the government gets the cash flow in advance. And number two, forcing the service providers to declare their income and file their tax returns because tax will have been withheld at source. And the effective date of that proposal is 1st of July, 2023. Then there's this other issue of turnover tax, and the changes or the proposed changes are twofold. Number one, the proposal is to now change the applicable rate from 1% to 3%. And this can be argued that, that we're just moving back to the pre-COVID tax rates. Remember, before COVID, the tax rate for turnover tax was 3%. So this appears to just clawing back the advantages we got from a tax perspective during the COVID era. And number two, the thresholds have been reduced. Currently, for someone to pay tax under this regime, your turnover is between 1 million and 50 million. And there was a reasoning for this because under the Companies Act, a small company is defined to be a company whose turnover does not exceed 50 million. Understand that was the rationale for that. So now the proposal is to bring the lower threshold to 500,000 and the upper threshold to 15 million. There'll be two implications coming from these proposals. Number one, someone who was not paying tax because their turnover was less than 1 million, then they will be required to pay tax under the current regime if the proposal is enacted the way it is. And number two, there are some taxpayers who are paying tax under this regime, but they will now follow from the turnover tax, and they will now be required to pay tax under the normal regime, where they will pay tax at 30% of their taxable income. So the impact of this proposal is that first, we'll bring more people into the tax net, and number two, more taxes will be levied because we were seeing quite a huge number of taxpayers who will be exiting from this regime to the normal tax regime. The effective date of this proposal is supposed to be 1st of July, 2023. The other notable change is about modification of interest restriction rules. You're well aware that starting 1st of January 2022, we moved away from the simple thin capitalization rules where we are looking at the ratio of debt to equity, and if that exceeded 3:1, then you are supposed to have restricted the interest. Now we moved to restriction of interest if your interest expense is more than 30% of earning before interest, tax, and depreciation and amortization. However, under the current law, the interest to be restricted includes loans that have been sourced locally and also from foreign institutions or foreign lenders. And the big question was, when we restrict interest from a local loan provider, what is the risk? Because this person is resident and they will be they are tax resident and they're required to pay their taxes in country. So maybe the bill may have factored those proposals into action. And what it seeks to do is to first only restrict the interest expense that is coming from foreign sources. And here it doesn't matter whether the foreign lender is related to the local person or not, but that is a welcome move. And number two, it proposes two things. This interest expense that has been restricted, a taxpayer has an opportunity to claim it in the subsequent 3 years if the interest, the thin capitalization, as we would call it, reverses. That means that your interest expenses are less than 30% of EBITDA. Number two, the deferred foreign exchange losses have been given a timeline in which a taxpayer can claim. Under the current law, you could claim that foreign exchange losses into perpetuity, but now the bill proposes to curtail the period of claim to 3 years. So notable changes, and we wait to see what will happen in the Finance Act. The effective date of this proposal is January 1, 2024. So moving on to personal taxes, and here there were not many, and I have summarized them here. The first one is about exemption on travel allowance or mileages, what we usually refer to per diems. So the proposal here is to try and enshrine a practice into the tax registration, because here the proposal here is that for travel allowance to be treated as tax exempt, it must be aligned with the standard mileage rates approved by AA of Kenya. This has been a practice, so it's just to try and enshrine this into the law. The effective date is July 1, 2023. The other thing is that touches employee taxes is the proposal to tax club entrance and subscription fees on the employees. Remember, from 2021, these expenses are not allowable on the company. And this proposal now seems to have a double taxation edge in the sense that it will be taxed on the employee and it will also be taxed on the employer. Quite punitive, and we wait to see whether there'll be some amendments after public participation on the Finance Bill 2023. The other item touching on employee taxes is about exemptions for public officers, where there have been some reimbursement when they're on official duty, where they have purchased an item. And as per the reading of the Finance Bill, it says that it doesn't matter where the ownership of that asset sits, whether it's for the government or for the public officer. So this proposal is likely to create some loophole in the sense that there's possibility for abuse there, because the ownership of the asset can be with the employee, and yet we are saying it will be exempted from employee taxes. The effective date of that proposal as well is 1st of July 2023. There's a new introduction about taxation of company shares with respect to eligible startups. And the issue here is about taxation of shares that are being granted to employees. And the taxable value will be the fair market value of the shares. And the tax will be taxed, the benefit will be taxed within 30 days of the earlier of number one, the expiry of 5 years from the end of the year of the award of the shares, the disposal of the shares, or the date the employee ceases to be an employee of the startup. So this is, I think, something that will be relevant to the micro and small medium enterprises, so that they can be able to maybe remunerate their employees from a different perspective. However, for someone or for an entity to be an eligible startup, there are some conditions to be met, and key is the turnover threshold of not more than 100 million and a raft of other measures. The effective date of this proposal is 1st of July 2023. Then I think maybe cognizant of the fact that we have so many medical fund drives for retirees, the bill proposes to create a tax relief on contributions to post-retirement medical fund, and the relief shall be 15% of the contribution or 60,000 per annum, whichever is lower. This is a welcome move for employees in this country, and the effective date will be 1st of January 2024. The other thing that looks like a cleanup in the income tax law is that the bill seeks to scrap the current provision whereby a wife can declare and assess the tax, her tax based on the husband and do a consolidated return. The bill seeks to remove that provision. What is not clear is whether the joint filing of returns for spouses is still affected. Maybe that is a clarity that we'll seek to have as if the act is amended in the current state of the bill. The other emotive matter since the bill was published is about the introduction of a new tax band of 35% for all income over 6 million in a year. That translates to 500,000 in a year, and it should be taxable at 35%. And this is not the first time that the government or Treasury is introducing this or trying to introduce the new band. Remember, in the Income Tax Bill 2018, there was such a similar proposal. However, the threshold was much higher because it was starting at 750,000 per annum. Not sure what has informed the lowering of the threshold. And number two, the other question is this proposal tax neutral? Because it is seeking to tax natural persons at a higher rate of 35%. What about artificial persons or corporates? Are they not also making super profits? So that the questions that we're asking ourselves. If it is enacted in its current form, then those affected will pay the higher tax from 1st of July 2023. Then there's the issue of the National Housing Development Fund, and this proposal is coming through the Employment Act. And here there's a proposal that every employee will be contributing 3% of their monthly contribution to the fund, and the employer will match the employee's contribution. But the two of them, their contribution is capped at 5,000 per month. So to employers, this is a straight 3% on the salary cost that will be required to be contributed to the National Housing Development Fund. And the impact of this is that for the employees who benefit from this or who qualify, they will get the affordable house. For the rest of the ones who will not qualify, then after a period of 7 years, they'll have their contributions remitted to a retirement benefit scheme or a pension scheme of their choice, or transfer the same to a person who is registered or who is eligible for the affordable housing, or to a spouse or dependent children, or even get their contributions back in cash after the 7 years. And the contributions will be remitted together with pay-as-you-earn by the 9th of the following month. The quick question here is that for most of Kenyans who may not be qualifying to get the affordable house, they'll get their contributions refunded in cash, and that will be taxable. The question is, why would the employee contribution be taxable, yet he's contributing out of his taxed income? So those are the questions, and there's maybe an issue that needs to go in through the public participation. So with that, I would ask my colleague Stephen to present on the VAT and other indirect tax measures.
Thank you, Rachel. And good morning, everyone. I believe it's still morning. We will now go through the indirect tax measures or the bill proposals. We will start with value-added tax, then we look a little bit on excise, and also we will talk about miscellaneous fees and levies act, and that is where your export levy and the other levies would fall. To start us off, the bill is proposing several changes as far as VAT is concerned, and I believe, and you would agree with me, that most of these changes within the VAT proposals are what would befall the manufacturing sector. And to start us off, we all know about the LPG, that is liquefied petroleum gas, which is proposed, whose VAT rate is being proposed to move from the current 8% to exempt. Now, there has been several, school of thoughts around this, and there's some people who are saying this is a good move. But we know, you and I know, that once this moves to exempt, then all the inputs for those players, they will not be able to deduct input VAT that is related to this. So more often than not, we are going to find these inputs being finding their way into the final, pricing. So it's worth noting that. We also know, and of the great proposal also on the petroleum products, and this will have far-reaching effects, in my opinion, because we are having to scrap off the reduced rate of 8% on the petroleum products, which is petrol, diesel, kerosene, and also aviation fuel and others, where this now will be taxable at 16%. I know that all of us this morning, you found out at the pump that the price of petrol has gone up from 179, I believe, to 182, 183 shillings. And this is actually before such kind of an implementation. So the expectation here is that if this goes through, then of course, the prices of these particular products are going to be much more expensive, which has far-reaching effects to the commodities and the cost of living for the people. There is also a proposal on the clarification of the place of supply, and this is what the bill is seeking to amend Section 8.2 of the VAT Act. And this is in line with the non-residents who are registering for VAT currently in Kenya under the DST, that is digital supplies. And this particular change is to the effect that the supplies that they do make, it doesn't matter whether they are making it to a registered or a non-registered person. And for that reason, then they should be required to, they will be seen as making supplies in Kenya. And we know this is in line with what the change that came through in the Finance Act of 2022 to bring on board VAT on digital services for both B2C, that is business to consumer transactions, and also business to business transactions. Then we also have a clarification on the claim of input VAT, where now the bill is proposing to, bring the two, when you look at the Section 17, there are conditions upon which a taxpayer is supposed to fulfill to be able to deduct input VAT. And part of it is the documentation being a validly issued tax invoice, and also that the supplier is supposed to have, declared this input VAT, which would be their output in their VAT return. I know that this has been brought a lot of administrative changes or challenges, because this requirement has been difficult to comply with, especially because you, the one who is claiming, you do not have visibility of what the supplier is doing as far as declaring is concerned. However, I see this as a punitive one, but we know that with the advent of teams and e-teams, it would not necessarily, for those that taxpayers that already have implemented teams and e-teams, and the objective of it is that you would be able to view and be able to claim only which has been issued, only input tax that has been issued through teams. So even the issue of documentation would be a thing of the past, but we know there are still challenges on these teams and e-teams implementation. So it's good to be aware of this. We are also seeing an expansion on the scope of taxable supplies, and this will have several effects, especially within the insurance sector. What the suggestion here is, or the proposal here is, that if you, as a taxpayer, are getting a compensation for taxable supplies, and this, to give an example, is, you have taken, for example, a cover and insured your taxable supplies, your stock, and the eventuality happens and you get a compensation. What the bill seeks to say is that that compensation should be treated as a taxable supply and VAT should be paid. The question to ask ourselves here is, and the bill should address, is that, are we saying therefore that insurance, the indemnity that taxpayer will get should be considered as consideration for VAT purposes? That is number one. Then number two, who should be responsible? Is it the insurance company that is making the payment? Are they the ones who are supposed to account for that particular VAT? And also, I think the fundamental one here is, I think it negates the spirit around insurance services and that which is exempt. We know general insurance services are exempt. And also the other point here is that under the maxims of insurance is that the indemnity that you do get is not necessarily a benefit. It's merely trying to bring you back to where you are. And I think this needs to be debated a lot, at least so that we see how it spans out at the implementation stage. There is also a clarification, which is a good move on keeping of records, that now the restriction that records can only be kept within Kenya for any taxpayer is removed, meaning that taxpayers can also maintain their records outside of Kenya. This is a welcome one, especially for those players within the digital space, those who are required to register for VAT under the simplified registration. Remember, those players or those taxpayers do not necessarily have a physical, an establishment, a physical establishment in Kenya, and continuing to require them to maintain their records only in Kenya would have been punitive. So this is a welcome one. Then we do have, like it happens every year, where different supplies are moved from different VAT rates, from exempt to taxable to exempt, or to zero rating, and vice versa. And this bill has not has also done the same for this year. There are several items that were exempt. They're being moved or proposed to move to 16%. We just highlighted some, not all. So the list here is not exhaustive. But worth noting is bioethanol vapor stoves classified at a HS code 7321-1100. And this, I think, is critical for the manufacturing sector, that the proposal is to now make it taxable at 16%. There is also a plant and machinery and equipment used in the construction of plastics recycling plants. And I think this is not a so good one, especially when you look at the other side of things, where we are trying as much as possible to spur the manufacturing sector within Kenya. And then worth mentioning is capital goods, the exemption of which the Cabinet Secretary may determine to promote investment in the manufacturing sector. Sometimes I look at these changes and these movements and I wonder, what is the rationale? On the one hand, we are saying that we are supporting the manufacturing sector and we want to spur manufacturing within Kenya. And then on the other hand, we are strictly doing the opposite as far as supporting that particular sector is concerned. Perhaps it's good to know and be able to be consistent. And I'm happy that perhaps now we have seen there are efforts for us to have the national tax policy. I know we have seen the drum in, although even at the brief look of things, there's still not so much to be desired, but I believe it's a step in the right direction. I don't want to dwell so much, but let me talk about that which is still moving from exempt to taxable. Worth noting here is we have taxable services for direct and exclusive use for the construction of specialized hospitals with accommodation facilities. And of course, it is pegged on the recommendation by the Cabinet Secretary. The point I wanted to make here is that that which is moving from exempt to taxable, there are those perhaps taxpayers who might have already secured exemption, and at the time of this bill or at the time of the Finance Act, assuming that the bill is going to finally become an act in its current form, there are those taxpayers who might have already secured exemption and maybe the time has not lapsed. It could be for 4 years, 3 years. So this a transition clause is very important so that it can cushion them, such that even if you had already secured that particular exemption, the transition clause here is the effect that your exemption would continue until such a time that which you had secured becomes is exhausted. So this is very, 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 very important to have a note around. There are those also supplies that the bill proposes to move from taxable to exempt. And I want to speak a little bit on the exportation of taxable services and the transfer of business as a going concern, right? So we know that for exportation of taxable services, this has been an emotive one for the past almost 1 year. With the Finance Act of 2022, we experienced a not so welcome move as far as taxpayers and manufacturers is concerned, and the whole administration of exported services is concerned, or the VAT on exported services is concerned. This was moved to taxable, or has been taxable since July 2022, with the exception of business process outsourcing, or those exported services that would be in relation to business process outsourcing. The definition of the same was not given, and we have seen several cases. There's a case that was decided towards the start of this year, that which several stakeholders had gone in, and the High Court, of course, dismissed that. So I think now resulting or reverting exportation of taxable services now are exempt. What this means is that now the issue to do with the VAT on imported services will start kicking in, because we know that we account for reverse VAT to the extent it relates to making supplies that are exempt. So I think it is worth noting that this is something that we taxpayers are going to grapple with. The transfer of business as a going concern, this has been some lobby topic for the last 3 years. And I think this is a welcome move, especially at that level, because it aligns itself to the best international VAT GST standards, and at the same time, it encourages lots of investment within Kenya. I also wanted to talk about this one, that is some of the supplies that are moving to zero rated, and that is inbound international sea freight offered by a registered person. I think this is a good one, because the players within this sector will now be eligible for VAT refunds, actual VAT refunds for the Kenya Revenue Authority. So it's a welcome one for those who are in that particular sector. There are those items or supplies that are now moving from zero rated to exempt. I know this is where most of the players within the manufacturing sector, in my opinion, or in our opinion, we feel is a bad, it's not a welcome move, because these particular items, and especially you look at agricultural pest control products, you look at transportation of sugarcane from farms for milling factories, you also look at largely inputs or raw materials that are supplied to pharmaceutical manufacturers in Kenya for manufacturing medicaments. I mean, we are going at the heart of it as far as manufacturers is concerned. And what we are doing is that we are removing the benefit to these manufacturers where they were now under zero rating, they were able to at least get VAT refunds. When we exempt, what we are saying is that that input cannot be claimed, cannot be deducted. So it's either pushed to the final pricing to recover this. And I think the intention was not this, because again, the benefit is not there. If you ask me, I would rather someone were moving them from taxable to exempt, but now we are removing them from the benefit that they already have, in my opinion, of zero rating to exempt. I think this needs to be rethought, especially if the intention of the government is indeed to give relief and also support or spur manufacturing sector within Kenya. Just a continuation, and fertilizer at the same time, or inputs for raw materials for imported by manufacturers of fertilizers. This is also a continuation of the same, where we are moving from zero rating to exempt. Let's change gears and talk a little bit about excise duty, and like VAT and other taxes, we have also seen the same. Some so positive ones, and most of these are not so welcome, especially given the agenda of the day. To start us off for excise duty, we see the proposal to amend Section 2 under the definition of excise control. This is purely housekeeping, because the reference to Section 23 had earlier been removed. So, and it was not existing within the Excise Duty Act. So to reference that to Section 24, which is the correct one, is purely housekeeping. Then there is also the issue to do with repeal of Section 10. This is really a good one, because the discretion of the commissioner now to make inflationary adjustments every year on the specific rates is now being proposed to be removed. It's a welcome move, because we see this every time happen, either in October of every year. And this has been posing a lot of administrative challenges, especially for those who are dealing with accessible products, because you are moving from some changes that are being that normally happen effective July, and then a rate changes in July, and then you can't even know how to progress, because you know that come October, that same rate that changed in July in that particular year is also adjusted for inflation. So, I mean, it's such a nightmare to have this, especially for accounting and as far as your systems are concerned. Administratively, it is usually very cumbersome. Now, there is also a proposal to amend Section 20. This is a welcome one, because for those at the point of a license being suspended, and now the taxpayer or the commissioner is being given specific timelines within which to respond to a taxpayer on the decision. And also, given that we have 14 days for responding for both of them, this is a good one, because it had left taxpayers in limbo, especially where you're still waiting for the commissioner to respond, or for you to know as a taxpayer what you're supposed to provide to this particular, to the commissioner at the point of appealing for a license, an excess license suspension. There is new proposals. These were not there, but generally these are introduction of additional penalties with regard to excise stamps, where there is a case of defacing or printing of an excise stamp for accessible goods or packages, and or where a taxpayer would possess accessible goods without the required excise stamps. And generally also the offenses that are being proposed here is a fine not exceeding 1 million, I think 3 Kenya shillings, and also imprisonment or the same. I think this is in response to the counterfeits and counterfeit excise stamps. We have seen several measures being put over the years on this particular menace. And I don't know whether this is going to curb it. We hope it does. And because we know that effectively perhaps is the implementation of the same, but this is an introduction to at least try curb that particular menace of fake and counterfeit excise stamps. We have also seen the amendment to the first schedule on accessible goods and their rates. And there is a proposal to delete condensates per 1,000 liters from excise duty. So meaning currently we know that these are taxable. The excess duty is Kenya shillings 6,868.94. The proposal is to remove excise on this particular item, which is a great move. There is also on imported white chocolate, and the definition is the one that is being amended, but it has far-reaching effects, if you ask me, because now we have an add-on for those items of chocolate and preparations of 1806.31, 1806.90. It means that this now would be excisable. So and of course some of these items are that which go into as raw materials into making several items. So meaning that if you bring them to the ambit of excise, then what you're saying is that the end product will be affected. I think the one that I really wanted to highlight and my focus would be the articles of plastic of tariff heading 3923, and we are introducing the word imported. So meaning now imported articles of plastic of tariff, that tariff heading will now be excisable. So for the locally manufactured, they will be removed from the requirement for excise. We also have the same for pasta of tariff 1902. We are introducing the bill proposes to introduce the phrase or the word imported, so that locally produced pasta will also be excisable, because we are deleting the word imported in that particular definition. So mixed bag, if you ask me. Then we also have these other items as far as excess duty is concerned, and imported fish, and these are new. These were not there before. There was no excess duty on these particular items that are being projected now. So imported fish will now be accessible. There is powdered juice. It will now be accessible at Kenya shillings 25 per kg. We also have sugar, excluding sugar imported or locally purchased by a registered pharmaceutical manufacturer. Sugar being one of most of the inputs that go into the manufacturing most of the e-trays and end products. I think this will have a negative effect unless we do have this lobbied against. We also have a new entrant, which is imported furniture and excluding furniture originating from the EAC. I know the reason given by the government is that they are cushioning local manufacturers, but we are waiting to see how this pans out. Also, the cosmetics industry and sector is not left out. We have seen these new entrants, the human hair, the wigs, and other beauty products, which the bill is proposing to introduce excise at 5%. Some of these items also are new. The imported paints and varnishes, and also imported test liner of heading 4805-2400. And the suggestion or the proposal is to include excess duty at 25%. Also imported sugar confectionery of heading 1704. And the change here is deleting the word imported. And what we know that is that this will have the effect of now bringing in into the habit of excise locally manufactured sugar confectionery. These are several services that we have seen whose excise duty has changed as well. And there are some accessible services whose duty has been proposed to increase. And the only one that has been proposed to reduce is the telephone and internet data services. The proposal is to reduce it from 20 to 15. And I think the one that I wanted to highlight here, and I know my colleague had touched on, is advertisement. So if you are making any advertisement on TV, print media, or billboards, and that advertisement, the fees, that advertisement is in relation to alcoholic beverages or betting, then fees charged on such advertisements will be subject to excise duty at 15% if this passes. Right. And then lastly, we will brush through the changes that have been proposed under the Miscellaneous Fees and Levies Act. And notable one is on IDF. There's a proposal to reduce the IDF rate from 3.5 to 2.5. And this is a welcome move. Of course, it reduces cost of the imports. And but however, there is also a proposal to remove the reduced IDF or to scrap off the reduced IDF rate on imports by manufacturers and entities in the construction of affordable housing. And the bill seeks to reduce this, to increase this from 1.5 to the 2.5 IDF rate. So, I mean, the benefit there for manufacturers, again, is out of the window because it's being aligned to take the proposed IDF rate, right? There's also the removal of the same reduced rate on goods imported under the EAC duty remission scheme. Again, we are moving from 1.5 to 2.5. And the implication of this, we all know of this, the scrapping of this reduced IDF rates is specifically to these manufacturers is the increased cost of production. Again, on RDL, that is the Railway Development Levy, we are seeing also a proposal to reduce RDL to 1.5%. And from the current 2%, I reckon that the bill is referring to the current rate as 2.5, which I think it's an error. It's from the 2% to 1.5. And then the removal of the reduced RDL rate for manufacturers and entities in the construction of affordable housing. The scrapping of this I mean, of course, it will not necessarily have any effect because we are moving from 1.5, which is currently the reduced rate. And if the RDL is being reduced to 1.5, so we are saying that, the rate remains the same for the reduced rate ideally remains the same as it were. Maybe perhaps if they were to retain this, we should have seen it go down to make any impact. But for now, this is being aligned to the proposal to reduce RDL to 1.5. We see also some changes to do with the export and investment promotion levy, and the bill seeks to introduce the export and investment promotion levy on goods under the newly introduced third schedule. Yeah. And some of these export and investment promotion levy is a new one. And some of the items, the levy here is proposed to be 10%. And some of these new items that are brought into the ambit of export and investment promotion levy are cement clinkers. This will be huge also for the cement manufacturers in Kenya. We also have bar rods or non-alloy steel, the steel industry also being touched there. And we also have sacks and bags and other sacks and bags, including cones, just to mention a few in the newly proposed introduced third schedule on export and investment promotion levy. Again, on the export levy, that is some amendments to the first schedule, which dictates on the export levy. There is a proposal to amend the first schedule, which contains goods that are subject to export levy. That is amending of tariff numbers and also those descriptions in the various of various raw hides and skins and leather items. And what these amendments are generally doing and overally is that they're representing a reduction in the export levy rates for these items from 80% or USD 0.52 per kg to 50% or USD 0.32 per kg, whichever is higher, right? Then we also have that proposal that export levy be applied on additional base metals. Again, the steel and metal industry being touched again here, but we have the specific tariff heads that are being affected, and export levy will be applicable on those. And then worth noting is molasses of tariff heading 1703, and the proposal is to have export levy on these at 20%. Right, the proposed effective date for this is July 2023. Now, we also do have proposed amendments to the second schedule on IDF exemptions and RDL exemptions, such that with effectively 1st of July 2023, the bill is proposing to exempt from IDF all goods and parts of Chapter 88. This would be your typical aircraft, spacecraft, and parts thereof. The proposal is to exempt them from IDF and also exempt them from RDL. And I think the positive one also is also the exemption of both IDF and RDL on LPG. And this is a good one, especially in light of the exemption that we have seen from a VAT perspective, although it has its challenges from a VAT perspective as regard input deduction on the same. Thank you very much. And I invite my colleague Richard to continue with Tax Appeals Tribunal Act and the rest of the acts.
Thank you, Stephen, for that. So I will now take the rest of the presentation to talk about tax administration matters and tax collection matters, because there were a raft of changes that came through, or proposed changes that will affect the Tax Appeals Tribunal Act and the Tax Procedures Act. Just 1 minute. Okay, so one of the proposed changes to the Tax Appeals Tribunal Act is to allow the tribunal to seek for additional documents in support of an appeal during the appeal process. And I think this is a welcome move because it will create room for the tribunal to look at the tax dispute from a complete position. And this may, will ensure that taxpayers have a fair hearing on the matter. That's a welcome move. Then the other notable proposal from a Tax Appeals Tribunal Act is the issue of requiring for security when filing an appeal at High Court after a tax decision or after the Tax Appeals Tribunal has made a judgment and which is in favor of the commissioner. Now, this is not the first time that we are encountering such a proposal, because as you remember, in the Finance Bill 2022, there was a similar proposal, but which didn't see the light of day. I mean, getting into the Finance Act 2022. And here the proposal was that before a taxpayer appeals at the High Court, they needed to pay 50% of the tax of the disputed tax. And this was supposed to be remitted to an escrow account created by the central bank. However, the proposal has come in, although from a different perspective. Now, the percentage required here is 20% of the disputed tax, and this tax will be remitted to the commissioner, who, if the taxpayer wins the case at High Court, then he'll be required to refund the tax within 30 days. From a practical perspective, not sure how that will span out. And maybe looking at it, not everything is lost, because we know that when a taxpayer loses a case at the tribunal, KRA usually comes in to demand for the tax. So, and they have to go and get stay orders to restrict the commissioner from enforcing collection measures. So maybe this is a positive, this is a positive side of this proposal. However, we've seen in practice where there have been arbitrary assessments being raised by the tax authority. So if the tax payable is so I mean, if the tax assessment is very is raised from an arbitral perspective, then the 20% of the disputed tax could be corrosive, and maybe some taxpayers will have challenges paying that. We'll wait and see how that will be, how it will span out. The effective dates of those two proposals is 1st of July this year. Moving on to the Tax Procedures Act proposals. All right, so from a tax procedures perspective, there are a raft of changes, and let's look at all of them. So the first one is the bill proposes to repeal section 37 that empowers the commissioner to refrain from assessing or recovering unpaid tax due to difficulties or inability to collect the tax. This is the provision that we usually refer to as abandonment of tax. So, and this proposal appears to come from alleged misuse of this provision by the responsible persons. So this one will have far-reaching consequences to the taxpayers, because the commissioner has no right to abandon a tax in whichever situation. The other proposal is about introducing a tax amnesty program. Remember, we are in the last leg of the current tax amnesty, where the final tax is, or the filings need to be done by 31st December this year, and the qualifying taxpayers will be eligible to waiver of penalties and interest amounting to 25% of whatever amount it was. So the proposal here is to introduce another amnesty program, and this relates to taxes that have been paid up to December 2022, and so in this case, the commissioner will be refrained from recovering the said penalties and interest. And in a situation where the principal has not been paid yet, then the taxpayer is allowed to make arrangements with the commissioner to pay that tax and apply for the associated waiver of interest and penalties. Now, this proposed tax amnesty program is closely tied to another proposal whereby the commissioner will have no right going forward to waive any penalties and interest. And this will have far-reaching implications because now taxpayers, in addition to paying the principal tax, they will also be required to pay the associated penalties and interests. There's something you've done, I'm not able to move. Just sit here. All right, moving on. There's another proposal in terms of security for property for unpaid tax. And this is not new because in the current law, where a taxpayer has not paid a tax and the commissioner has authority to inform the registrar in writing that the property will be used to pay that or to offset against that tax payable. So the change here is that the notification will be done within 7 days as opposed to 14 days. The other proposal is about agency notices, and under the current law, the commissioner is empowered to institute an agency notice or to issue an agency notice where an objection decision has been issued by the commissioner and the taxpayer has not responded to it within the stipulated time. Now, the proposal is to expand those powers and give the commissioner more powers to, in addition to a taxpayer not responding to an objection decision within the prescribed timelines, he now has powers to issue agency notices in respect to a tax assessment that has not been responded within the prescribed timelines, or an appeal that has not been responded within the prescribed timelines. The other thing is that if a taxpayer has defaulted in paying a tax installment, they'll have the commissioner will have power to do that. And in addition to where a taxpayer has made a self-assessment return and has not paid the principal tax. So this is very key and taxpayers need to be cognizant of that fact. So moving on, there's the issue related to appointment of value-added tax withholding agents. And this is just an introduction to registered manufacturers, whereby the suppliers will be subject to withholding VAT, whose value of investment in the preceding 3 years is at least 3 billion. So this is our introduction, and of course, it will have far-reaching consequences. And the thing is, the payment date is within 3 days after the deduction, as opposed to when we know that the withholding VAT is payable on or before 20th of the following month after the deduction. So that will have adverse effects on the cash flows of the affected taxpayers. The issue of appointment of rental income tax agents, this is not new. This provision sits under the current income tax law. However, this is just being moved to the Tax Procedures Act, just for purposes of aligning all the tax procedures. On the emotive issue of refund of overpaid taxes, I know this has been something that has been deliberated on in this country for quite some time. So the changes that have been proposed here is, number one, the overpaid tax will now be available for offset against current outstanding debts. Currently, the law just provides for future tax liabilities. So if this is reviewed and approved by the commissioner, then you can, as a taxpayer, you can use it to offset against your current tax debts. The other big item here is that the refunds for overpaid taxes will have to be issued within 6 months, as opposed to the current 2 years. So that is a welcome move. And the bill also proposes a 120-day time frame for the commissioner to dispense with the applications. So that is a welcome move because the law has not provided for any timeline. So moving on to the other proposals, there's the issue of treating an objection decision whereby under section 51, the commissioner is empowered to review an objection decision, and if it is invalid, then under the law he is required to notify the taxpayer within 14 days that the objection that the taxpayer has filed is invalid. So the change here is that now the taxpayer will be required to provide the required information within 7 days. So there's a notification within 14 days, and then the taxpayer will be required to provide the required information within the 7 days. Another one that is of housekeeping in nature is the issue of extension of ADL timelines from 90 to 120 days. That's just housekeeping. And the one that I talked about earlier on is that now the commissioner will no longer have powers. No, this is different. So this one is about the bill proposes to amend section 56 that gives the tribunals and the courts some discretionary powers to allow for new grounds of appeal on application. So this one will have far-reaching implications because the taxpayers now will be required to make sure that their appeals are watertight from the very beginning, because there will be no chance for the tribunals or the courts to allow you to introduce new grounds of appeal. Then there's the issue of production of records, and the bill seeks to create the legal framework to allow the commissioner to come up with a comprehensive data management and reporting system that will allow for transmission of electronic documents and transaction data. We know that in the current business world, the Revenue Authority of yesterdays is not, or is ill-equipped to deal with the business challenges and the business advancements of the modern world. So there's a proposal for the commissioner to come up with a more comprehensive data management system that will give him real-time data or more information to enable him carry out his mandate. And of course, this is very much tied to the issue of electronic tax registers geared towards having the commissioner having more information about taxpayers. Another notable change is the issue of tax shortfall penalty. So under the law, if a taxpayer gives false or misleading information to the commissioner, then he is required to be charged 75% penalty on the tax shortfall. So the proposal here is to move that 75% to twice of the amount of the unpaid tax, which is punitive to taxpayers. And I talked about this last proposal about the general provisions relating to penalties. So here, the commissioner going forward will not have any leeway to waive or remit penalties on interest. That means taxpayers will be required to pay the principal tax and the associated penalties, all interests. And I think, Job, that is the end of our presentation. We give you back the mic.
Thank you so much, Rachel and Stephen, for quite an elaborated presentation on various aspects of taxation policy from Tax Procedure Act, that is TPA, income tax, excise duty, VAT, and various issues that have come up during the presentation, which probably we can deep dive on as we go on with this webinar. So thank you so much. Indeed, I'm looking at the Q&A. I can see still various questions are coming up. Fred Ogola has raised a question. Gladys Kolo, Kalpesh Patel, then Venkata, and many others. Thanks so much for this. I'm going to encourage the panelists to look at these questions, and they can answer to those that they can be typed back to the whole audience, so that we can be able to handle as many questions as possible. However, I'm going to let my colleague Ruth, who is my co-moderator, Ruth Lemlem, who is the manager for legal and regulatory in Kenya Association of Manufacturers, to take us through some of these questions once I've taken the first batch of questions. At this point, I want to introduce now a rich panel of two tax experts. One is a CAM director, that is Mihail Sharishaza, and also we have Hadija Nanyomo, who made some opening remarks a while back, who is a partner and principal under the indirect tax bracket in Ernst & Young LLP. They're going to respond to various questions that you'll have raised to them. But to start off, I would like to ask Mihail, my director, and yeah, I can see he's on the call. That what would you consider as major wins and the risks of manufacturers from income tax perspective out of the Finance Bill 2023 and the presentation that has just been done? What would you consider as the major wins and risks to manufacturers from income tax perspective, Mr. Mihir?
Thank you very much, Job. Thanks. My name is Mihir Chalisaya. Job, just to summarize, the major wins I would consider is the branch tax, which is reduced from 37.5 to 30%, is a good move. CGT interest carry forward for 3 years, interest restriction applicable only to foreign loans. And also, it's carried forward up to 3 years. It's a nice move. It will help manufacturers, particularly it's now restricted only to the foreign loans. I personally also like turnover tax for small segment. It's nice. It will help MSME. It is a very good move. And from tax point of view, monthly rental withholding tax has reduced from 10 to 7.5%. It's a nice move. Over to you, Joe.
Okay, thank you. Thank you, Mihail, and also for noting on those various areas that are a nice move for the manufacturing sector. Hadija, I have a question for you. What are some of the major wins that accrue to manufacturers in general terms?
Thank you, Job. It's good to look at the glass half full, but I'm finding myself really looking for the fullness and at pains. But in life, we have to remain positive. And I think one of the key ones for me that I think is good is the one around transfer of a business as a going concern, the exemption. We see a lot of entities either merging or restructuring or doing that. And such transactions had been disadvantaged. It had always been exempt. Best would have been 0 rating, but because both entities would be maybe one from non-resident and the other, exemption wasn't such a bad thing, but it had been removed. So for me, I feel that that is going to be a good one and it will spur. But the other good win, I don't know whether it's good, but I'm going to bring it in a way that will make us reflect on it. I'm still puzzled around the exemption on aircrafts and all. There's a particular section of us that will be happy, but I find it a bit interesting that things for manufacturers like capital equipment, which we've really been fighting for, machinery and equipment, to have VAT exemption have been left out of that bracket. So I would be happier if that section 88, which includes aircraft, spare parts and all, had included even chapter 84 and 85, which really affects manufacturers in terms of capital equipment. But the other good thing that I'm seeing is the fact that they've looked at some of the procedures, one around timing for going to the TAT or to the tribunal where they've extended ADR from 90 days to 120. At least there is more time for mediation. I'm also seeing areas around a few of the items that have changed from like export of services. When I look at export of services, it has been an issue where it has been 16%. It's now at exempt, and we are still saying yes, it's better, but it can get better or best to the best level we require, which is 0 rating. Job, I'm really at pain trying to look at the positives. I think that's a hard question, but I can stop there for now regarding the positives. It's quite painful to think of the positives. Yeah.
Thank you, Hadija, for noting that it is becoming a bit hard to look for these positives. That actually it is unprecedented bill that we have not seen for many years. But I'd like to throw this question to Michiel because I've seen that you had chatted a response back on TOT. That is turnover tax, and it's good because of the listeners to give us the difference between the corporation tax and the turnover tax, and also you try to describe to which categories they are charged and the frequency. Is it monthly or is it yearly? So that they can get the difference. And then can a company pay corporation tax at the same time pay the turnover tax?
Thank you. So I did reply, but basically turnover tax is applicable to companies whose turnover is below 50 million. If the bill is passed, then the turnover limit is reduced to 15 million per annum. That's the turnover. The company or the individual need to file monthly return and pay 1% currently, but 3% in future going forward if the bill is passed. They need to file and pay on a monthly basis before 20th of the following month. They don't need to pay 30% corporate tax if the turnover is below the upper limit of the approved turnover. So currently 50 million. They are not even required to file annual income tax return, which is corporate tax return, since they already filed turnover tax return on a monthly basis. So it's very simplified version, very simple return. One can see, and the very simple information is required. So it's primarily will help the small sector, and then they can really gain out of this.
Thank you. Thank you, Michiel. I have a question to Stephen concerning the excise duty. You rightly noted that we have some excise duty that has been put on imported products. Good to know that in the past, if we put excise duty on some of the imported articles without specifically mentioning that exemption for the goods that are originated from East African community, this actually amounts to an untariff barrier. And out of the schedule that you have presented, you have seen that there's imposition of excess duty on some products that are imported, but there's no specific mention of exemption of the goods that are coming from EAC. Do you think this is going to pose a new NTB for our manufacturers?
Thank you, Job, and I hope I'm audible. Absolutely, and I think it's I don't know whether sometimes, and this I'm coining it with my previous comment around, on the one hand, the government saying it wants to assist and spur manufacturing. Yes, that is very well received by everyone, but then the actions towards that support is not seen, in my opinion. And to your question, I think there is need to have that clarity, and if possible, have that exempted, especially that which is coming from the EAC, because I mean, to me, that is not a very welcome move, because at the end of the day, you are saying that our manufacturers within Kenya will stand at a disadvantage if this is not addressed, so that at least we bring them to the same level playing field with their counterparts within the EAC, and in the spirit of common market. Then I believe that I don't want to say that it was forgotten. Nothing, if it's not there, it's not there. But I think at the point of lobby, this is something that needs to come out very clearly so that we can have this particular benefit accruing to them and not leaving them at a disadvantage. So to your question, yes, I mean, it will have that negative effect, if I may put it that way. Thank you, Job.
Thank you. We go to Rachel. Rachel, you talked about EBITDA and the local loans being exempted from interest capping. What would have been the ideal situation based on the asks that have been put previously? Because you've seen that the last, I think, 2 years we have been advocating against the the limitation of the interest that is deductible. What would have been the ideal situation? Seems I could not get Rachel on the call. Repeat the question thereafter. Coming to
sorry, Job, can I just help you there?
Yes, yes.
SKM, we made presentation on this subject, and we had 2 or 3 specific asks, on this. One we managed to achieve, which is the foreign loans should be excluded. I think what we did not achieve is foreign loans from commercial enterprises should not be included. It should be only for related parties should have been included. 2, our ask was that there should be grandfather clause, introduced there, which means any loans which are, any loans which are already in place on the day, this rule was introduced should have been excluded. Because now, when you suddenly introduce such rule, we are penalizing people who already have borrowed, in the past, and then loans are outstanding. And the third thing, what is there very common in Europe is there should be minimum interest. There should be not subject to interest. So normally in Europe, it's 3 million euro equivalent interest, which is not subject to restriction. Anything more than that is disallowed. I can see Rachel has also raised a hand. Maybe she can also add here something more. Rachel?
Yeah, Rachel. Thanks, Michiel. Rachel, go ahead.
Okay, so one thing we need to note about interest restriction is that the reasoning behind restricting interest is to try and bring to par the financing through equity and financing through debt. Remember, financing through equity, whatever is paid to a shareholder, that is dividend, is not tax deductible. So what the tax law tries to do is to equate the 2 forms of financing such that one of them doesn't get an advantage over the other. So going to the proposals, number 1, the issue of removing local loans from that EBITDA computation, that's a positive move. Because remember, if you went to a local bank and borrowed, that is a transaction already at arm's length. Number 2, the local bank is tax resident in Kenya, and they will be required to declare and pay their taxes in country. Then the other thing about expanding this to to foreigners only and not related parties is just to help the revenue authority collect more taxes, because if it's possible to borrow from a foreign source, then they also be caught under that interest restriction. Another positive move is the fact that the restricted interest expense is deductible in the subsequent 3 years or 3 periods if the situation reverses. That's a good move. But the downside to that is that the deferred foreign exchange losses have a lifetime of 3 years. So that is that's a negative impact of the proposal as is currently worded. Back to you, Job.
Thank you, Rachel. I'm going to ask the last question before I allow my colleague Ruth Lernem to take over the other questions. And this is the elephant in the room. The question to do with the export development and levy, the one that was unleashed to us by Stephen in his presentation. Whereby we have seen some intermediate products that are used by our factories, clinker, metal, papers, some articles and some tariff numbers specific to some of these sectors. They are attracting an export development levy of 10%. And this now question goes to Hadija. We just completed the exercise to do with the review of the CET, that is July last year, whereby it is the finished products that are imported into the country that attract a duty rate of that 5%. But now in this case, we are seeing it is the imported products, imported intermediate products that are used as input by our factories that are attracting this export development levy, and not actually the finished products that are seated on the highest band, fourth band at that 5% in the ECCT book. Out of this, do you see like there is a philosophical difference from the CET to the export development levy? And do you think that we have actually the capacity locally to be able to supply, and that's the reason, the intermediate products, and that's the reason why we are being protected at 10% export levy?
I think for me, when I looked at this, on a lighter note, I was like, okay, let's not bring in so much the issue of the CET because it was done under a different dispensation. Maybe the new dispensation, it's like, for lack of a bit, for comparison purposes, when you divorce one wife and then you bring in a new one and you want to take out all the beds and anything that belonged to that person. So it looks like there was not much of a consideration of the past and what has been transpiring. We got the rationale that we are bringing in an export development and investment levy to boost and spur exports, which is a very good rationale. It's a very good view. But the reason I'm saying I think the past wasn't looked at is that there are so many other mechanisms already that are dealing with export promotion. We have councils, export promotion council. We have even the CET itself. It's looking at how best to boost exports. So when I look at, first of all, the items that are in there, the likes of paper, there's a bit of iron ore and alloys, majorly raw materials, and sacks, and clinker, which is also a raw material, a very key raw material for cement. I feel like, one, why those? Because they're just like four. So the question is, why those? And the question is, how was the value chain and the supply chain for the whole sector looked at? Because my point of thought would be that we would be looking at finished products, like you rightly said. So I think there was a policy mismatch here that is coming up, and it is going to negatively impact what we are trying to achieve in terms of boosting exports. Because when I look at the rate itself, 10% is quite high to be applied on raw materials. Already we know that from a technical and principles perspective, from a customs law perspective, from an international trade perspective, any raw material shouldn't ideally have any taxes on it. But now we are imposing a levy on it. So if I'm looking at, let's say, that particular product, it was already at 0%. There's a reason why it's at 0%. So why levy a 10% on it? My view is that this needs to be looked into. And indeed, if the rationale was for government to boost exports, then maybe other ways need to be looked into, or it has to be a broader view, because these are just very few items in that even if indeed it's there, what impact is it going to bring, overall impact to the whole economy? And what overall impact is it going to bring to all exports or boosting exports? So for me, my feel is that something is not right here. And as we do public participation, we need to look deeper into this and guide the government appropriately as the people in the businesses and the people who are affected, especially in the particular sectors that are affected. Thank you.
Thank you, Dija, for that articulation. And at this point, I want now to hand over the mic to Ruth to take the rest of the question to the end.
Thank you, Job. I hope I'm audible enough.
Yes, you are.
Thank you. So I'll go through the questions as put through the Q&A. And the first question is from Kalpesh Patel. This one I'm going to request Hadija to pick it up on insurance. So insurance proceeds are always net of VAT as they reinstate the cost value. Why VAT on it again? Wouldn't it be a double taxation? Hadija.
Yeah, thank you, Ruth. I think here we have to first get to the context of the amendment, the proposed amendment. The proposed amendment is about compensation for loss. And I think many of us have diminished or reduced it to mean insurance, but I think it's wider than insurance. And if I'm trying to absorb and understand this, I'm looking at it this way. I'm in business, and in some cases, I may have loss, any form of loss, and the loss may be arising within that proposed amendment. There's a reference to taxable supplies. And for me, when I think of taxable supplies, I'm looking at inventory. I'm not looking at capital goods. I'm not looking at anything else. What you supply as a business person. So if I have something I need to supply as a business person and I've got some loss out of it now, but later I get a compensation for that loss I have had, then what the law is proposing is that if those supplies were indeed taxable and they should have attracted 16% VAT, then when you declare in your books this compensation for the loss, it is looked at as income and it should carry the same treatment as the loss that you got. So my understanding, and I hope this was the spirit of the law, and I hope this is the interpretation that would be got, is that you had something, you lost it, you did not pay VAT for it, but then you've been compensated for it. So the assumption is that you have sold it and therefore you have to account for VAT on it. That is my humble understanding of that. If it's not clear in the bill, then we need to make it clear. And if that is indeed what is to be achieved or the objective of it, principally from a perspective of VAT principles, to me, it seems like it would be okay. Now, there was something about if VAT, probably if you're coming up, assuming it is insurance you're going to get, and when you're going to be insured, when you're insuring the goods, probably VAT is not included in there. I think for me that is okay. So when you get the compensation, the assumption is that it has VAT. It means that the rate you're supposed to apply would be the fraction. You assume that it is VAT inclusive, because at the end of the day, you have some income. You're reporting in your books, and that income is relating to goods which were supposed to attract VAT. Back to you, Ruth.
Thank you, Adija. And just keeping you there's the next question where the Gladys Akolo is asking, when I export steel products, does it mean that they will attract 10% and 20% excise duty?
I think Gladys is not so clear on the. I don't know whether she's talking about the export levy. Actually, the export promotion and investment levy is called that, but it is applied on imports, not exports. That is also the other interesting bit. It's a levy to develop exports, but it is applied on imports. So the steel products that are going to be exported would not attract the 10% the levy, the 10% development levy. It would only apply on imports of the same products. Then I'm not so sure how the 20% excise comes in, because as far as I'm concerned, it is only on imports. And the rate is now the highest band of 35%. And we must be cognizant of the fact that these products are so many and in so many forms. In fact, even in the tariff book, they range from a number of tariff codes, and also the rates range within that. So you'll find that some maybe are considered as raw materials, they will be at 10%, others at 35%, others probably even 25%. And for those that would be coming in under remission, they may even be at 0%. So I think, Gladys, the question is a bit general, but to guide you is that when they are being exported, there is no excise, and the export development levy is only on imports.
Thank you, Hadija. I think at this point I want to bring in Steve on the question of sugar. So Joachim has asked two questions. So one is sugar for industrial use has a specific tariff, that's 1701. Will this also be affected by the excise duty, as this was created to support the manufacturer, especially those under the DRS scheme? In the same manner, he's wondering whether there is a justification of the government amending the clause on sugar confectionery by deleting the word imported, as this is definitely going to kill the local manufacturing sugar confectionaries. Steve?
Thank you very much. And allow me to again start off with my large commentary around saying one thing and doing totally different thing. And especially when you say that you want to support the manufacturing sector or any sector. And this is exactly what, in my opinion, has happened here. Because the effect of removing the word imported, as it were, is to mean that initially, and as it is right now, it's only that which is imported is subject to excise. So when you remove the word or delete the word imported, you mean that even now the locally manufactured will be subject to excise duty. And of course, that goes against the initial objective of supporting the manufacturing sector. So I would agree with you that effectively this is not a welcome move, and rather would be killing the sector at that level. Now, to do with the sugar of that specific tariff, my take would be that the proposal as it is currently would mean that sugar for industrial use for that particular, specific tariff 1701.99, then would be subject to excise, unless we have a proviso to ideally include it under exemption. And perhaps this should be part of the lobby point, especially on sugar for industrial use. But the bill as it is and what it's proposing, without that clarity, then it means it would be part and parcel of excess duty. Thank you.
Thank you. I think Hadija has a comment on the powdered sugar, the powdered.
Yes, but I was typing the answer that there's for instance Sunquick. It's in a glass bottle, but it's powder. You add water to it and drink it, and at the end of the day, you're drinking the liquid juice. But at importation or at production, it's a powder, a juice powder. The proposal is to give it its own rate of excise duty. In my view, even before the current rates we have for juices would have sufficed. The only problem is that they were in per liter, and this is powder. So I think it's more of trying to clarify and bringing that powdered juice into the ambit of excise duty. I'm suspecting that before they were not paying excise duty at all, given that the rates were per liter, specific per liter. So the focus was more on the likes of those that are in liquid form, purely in liquid form.
Thank you, Hadija. That was the question about powdered juice. So thank you very much. I think that is it on the question and answer board. We have responded to all the questions. At this point, I think the hour already is at the top of the hour. It's 1 o'clock, and I want to close the meeting by first making a few comments that yes, we will make the recording of this meeting available. We will be sharing it through our usual platforms. We are also continuing to receive your comments as KAM and compiling them. We have, as it is right now, received quite a number of comments that we have a working draft memoranda that we intend to polish up. So if you have any comments, please do so before we run out of time. The deadline for submission to Parliament is on 20th of May, which is interestingly a Saturday, and we do intend to finalize by Thursday so that we have a good lead time. I think we appreciate all of you who have attended today's meeting. I want to appreciate the board members present. We have mentioned Mushai Kunia and the directors, Mihir Chalishaza. We appreciate your being with us in this meeting. We also want to appreciate the panelists led by the EY team, as well as here and our head of policy, Wanjohi Job. Thank you. I appreciate all of you. I also want to thank the participants who have listened to us and stayed through the meeting. This has indeed been an informative session. So thank you very much.